Alright, so welcome back to another video on how to secure yourself financially, quote quote. So right now I'm looking at the beginner guide to financial statement from the sec.gov website, and they mentioned that if you're able to read nutritional label or baseball or soccer box score, you can learn to read basic part of financial statement. And if you can apply for a loan or follow a recipe, you can learn the basic of accounting. And the basic is not that hard. And the reason why I'm looking at this is because I want to learn the basics and then apply to my own business. Okay? And if that business scale, well, I know a lot of these things where I know the fundamental, especially on the accounting and the financial statements. So if I need to hire more people, for example, an accountant uh, or any other administrative personnel, yes, I can do that, and I know what are the common language, all the mumbo jumbo, particular to their field, the accounting, just to mention one. So okay, that's good. That's great. Because now, with that knowledge, uh, this section is going to uh, give us some basic understanding of how to read these financial statement. Much like a superior class teach you how to perform basic cardiopulmonary resuscitation, but this section won't train you to be an accountant, much like a CPR course won't make you a cardiac doctor. But it can give you some confidence that when you're able to look at a set of financial statements, you can make sense of it. And this financial statement, after all, they show you the money. Okay, there is a very interesting movie from the Cuba Gooding Jr. Immortal Lines from Jerry Maguire. Show me the money. That's exactly what financial statements do. They show where the company money came from, where is it now, and where it went. And there are four financial statements. You have is the balance sheet that it show how much uh, the things that a company owns or what it owes at a fixed point in time. The income statement that shows you how much money a company spent and made again in a period of time. The cash statement shows you the exchange of money between the company and the outside world. And then you have, of course, in a period of time, and the statement of shareholders that show you the change of interest in the shareholders, again, in a period of time. So that section from the sec.gov, right, this beginner guide to financial statement, they show us is only the three, the first three statements, such as the balance sheet that, after all, it shows you the company assets, liabilities, and shareholders' equity. So assets are anything that a company owns that has value, and they typically can be sold or used to make products and services that can be sold. So you have tangible assets or intangible assets, where the first is things that you can touch, for like uh, inventory, machinery, land, building, and intangibles such as trademark or uh, such as trademark and patent. Also, cash is another form of assets in any investment that a company made. A liability is the amount of money that a company owes to others, and this kind of obligations can be money borrowed from from a bank to launch a new product, for example, environmental cleanup costs, a tax owed to the government, payroll a company owns to its employer, the amount of money owns to their supplier for materials, and any future obligation to provide good and service to consumers, right? And the shareholders' equity, which is also known as the net worth or the capital, it shows how much money a shareholder will receive or the owners will receive if all of the assets were liquidated and pay off all of its liability. So to understand how this balance sheet works or how is the structure of this balance sheet, with I look at the formula, assets are equal to the liabilities plus uh, shareholders equity, okay, and sometimes some companies or sometimes you might find this balance sheets where all of the company assets are listed on the left side and the liabilities and the shareholders equity on the right side, or assets listed on the top followed by the liabilities and shareholders equity. So okay, cool. So these assets, they are generally listed based on how quickly they can be converted to cash. So you have current cash, current assets, and non-current assets. So current assets are things that a company expect to convert into cash within a year. For example, inventory, okay, and uh, non-current assets. So a thing that a company does not expect to convert into cash, or it will take longer than a year. So in there we have fixed assets that are not for sale because it is used to run your business. Liabilities is generally listed based on their due dates, where here you have short-term or current liabilities and long-term liabilities. The first is obligation that a company expects to pay off within a year, where and the latter is one or do more than 1 year, right? And then the shareholders' equity, which shows the amount of money owners invest in the company stocks plus or minus the company earnings and or losses. And sometimes companies redistribute their earnings instead of retaining them. They call that dividends. So the balance sheet, after all, is just a snapshot, okay, of the assets, uh, liabilities, and shareholders' equity at the end of a reporting period. Sometimes this is based on a year or quarterly, okay? But for example, now let's take a look at example here from Coca-Cola, right? So Coca-Cola here, there you go. But let's go to look at the balance sheet. Here, balance sheet, okay? So these balance sheets, so they show you here annually or quarterly, okay? You click on quarterly, that's right, it's loading. Okay, so quarterly they show you is, yes. In this case, the way Yahoo Finance showed balance sheet is all the company asset list on the top, followed by the liabilities and the shareholders equity. Okay, so you have the total assets here, the current assets and non-current assets. Okay, uh, and the liabilities, what you have is the current liabilities and long-term liabilities. So payable, again, these current liabilities are obligations that a company expect to pay off within a year. Okay, and the total equity growth, or here the total amount of, or the money that investors, the money that owner uh, invest in the company stocks, plus or minus the company earning or losses. Okay, in a period of time, you have here like this. This is the total equity growth minority, total capitalization, common stock equity, net tangible assets, working capital, invested capital. Invested capital. Again, this balance sheet doesn't show you if doesn't show you the flow in and out of the accounts during the period, right? It doesn't show the flow in and out of the accounting period. So income statements, where now this show you how much revenue a company made and the expense and cost associated with earning that revenue. Okay, uh, in a period of time. So it can be either quarterly or annually. Here I'm looking at this quarterly. Okay, and at the bottom line, at the bottom of the statement, is showing you the company net earning or losses. So how much money the company made or lose or lost. So also you can see something called the EPS, where I don't think they show you. It's here EPS. Okay, earning per share is a calculation that show how much money the shareholder of the company will receive if all of the earnings were distributed among them. And company almost never do that. Instead, they reinvest that in their own business. And so to understand how these income statements are set up, we can think of them as a set of stairs, right? Where you have at the top the total amount of money made from sales of product and service. In each step, you make a deduction uh, of, from the cost. Each step you make a deduction in certain cost of associated with earning that revenue. And at the bottom of the stair, you have the bottom line. People call this the bottom line, and this show you if a company makes or lose money, right? So at the top of the stair, we have something called the gross profit. So which is a gross because deduction has not been made, or some expense has not been deducted from it yet. So here you have is uh, the gross revenue. Okay, so company does not expect to collect certain kind of money, a certain amount of money from a, yeah, a company doesn't expect to collect certain kind of money, such as sales discount or merchandise return. So when you subtract this return and allowance, right, any amount of money that a company assign or allocate to certain expense, okay. So once you subtract the returns and allowance from the gross profit, you reach to the company net revenue, and they call that net because if you can think that as a net, the revenue are left in the net uh, after all the after deducted the returns and allowance from it. Okay, so moving down the line, uh, we have is a set of expense, uh, but most of the time, right after the company net revenue, you might find is the total cost of sale or the cost of sale. So how much money a company uh, spend to produce product and service, uh, yeah, to produce product and service, to produce the good and service it sold during that accounting period, whether it's quarterly or annually. Okay, so then once you subtract the cost of sale from the or from the net revenue, you arrive at the gross profit. And they call gross because there's some expense that have not been deducted from it yet. And below or the next section after the gross profit deals with operating expense. And these are expenses that support the company operations, such as administrative salaries, the cost of research, product and service, marketing, and they are different from the cost of sale because they cannot be linked directly to the production of good and service. But again, is something that support your company operations. So you have is the operating expense, right? Also you have is the depreciation, which it takes into account the wear, the amount of use, and tear or damage that is certain kind of assets such as tools, machinery, and furniture, uh, which are used over the long term. So company spread the total amount of cost. Uh, Company spread the total amount of cost of these assets over over the period they are used, right? So because with depreciation, you take into account the wear and tear of some assets, machinery, tools, and furniture, which are used in a period of time. So companies spread the total cost of mm, yeah, the company spread the total cost of these assets over the period they are used. And this process of spreading the cost is called amortization or depreciation. So the charge of using or the charge of using these assets during the period is a fraction of the original cost of this asset. After all operating expenses are deducted from gross profit, okay, then after all operating expenses have deducted from gross profit, including depreciation, you arrive at the operating profits before interest and before interest and income tax expenses. This is often called income from operation. So next, because here what you're doing is just describing as this and then try to compose and combine that in a way that is easy to mention to others. You can create this narrative and you can tell someone else when they understand that, right? And it's important to slow down sometimes to see if the other is understanding. Okay, so that is depreciation. Okay, so after we deduct the cost of sales from the net company revenue, we reach to the gross profit. Okay, and they call gross because this number is unrefined, and there's some deduction. Uh, yeah, there's some expense that have not been deducted from it yet. So the next section deals with operating expense, like this. So the next section deals with operating expense. Expense are or expense that go to support the company's operation, such as administrative salaries, like this, right? It tells you here, administrative salaries, administrative yeah, administrative salary for administrative personnel, the cost of research, product and service, marketing expense, and these are different from the cost of revenue because it cannot be linked directly to the production of goods and service it sold in a period of time, that accounting period. So then you have is the depreciation, which also deduct from the gross profit, and this take into account the amount of wear and tear. Okay, that's right. It takes into account the amount of wear and tear, the amount of use and damage of certain assets like tools, machinery, furniture, which they are being used over the long term. So companies spread the total cost of these assets over the period they are used, and the process of converting or spreading this cost is called amortization and depreciation. So, for example, one straight way to calculate, one of the easy way to calculate is as a straight line. Uh, yes, a straight line. Yes, a straight line. Mm-hmm. Mm-hmm. That's a straight line. And so this is a straight line. And yeah, so this is a straight line. Mm-hmm. Uh, so once you deduct the operating expense and depreciation from gross profit, you arrive at the operating income before interest and income tax spent. So mm, next, company must account for interest income and expense, where interest income is the money company make from keeping their cash in saving account or interest saving accounts, money market funds, and the like. Right? And to me, it's like, what the fuck is money market fund? Okay, what the hell is money market fund? Money market fund. What they are, how they work, pros and cons. Money market fund. What they are, how they work, pros and cons. So money market money market involves the purchase and sale of large volumes of very short-term debt products, such as overnight reserve or commercial paper. So in other words, okay, so the money market involves the purchase and sale of large volume of very short-term debt products. Very short-term debt products such as overnight reserve or commercial paper. But it's a purchase of sell. It's a purchase and sale. Okay, but it's those two actions. Okay, the money market involves the purchase and sale of large volume of very short-term debt. So purchase and then sell a large volume of very short-term debt products, such as overnight reserve or commercial paper. Do you have an example of this? Type of money market funds. Prime money fund invest in floating rate debt and commercial paper of non-treasury assets like those issued by corporations, U.S. government agency, and government-sponsored enterprise. A government money fund invests at least 99.5% of its total asset in cash, government security, and repurchase agreements that are fully collateralized by cash or government security. Trust fund or treasury fund. A treasury fund invests in the standard. Okay. But again, these money markets, the TLDR, pros very low risk, high liquid, better returns than bank accounts. Better returns than bank accounts. Not FDIC insured. What does it mean this? What is the meaning of this? Financial pros, they are not insured by FDIC. What the hell? Financial pros that are not insurance. Federal Deposit Insurance Corporation. Okay. What products are not insurance? Stock investment, bonds investment, mutual fund, crypto assets, life insurance policy, annuities, municipal securities, safe deposit boxes, or their contents, U.S. Treasury bills, bonds, or notes. What the hell? And what do you insure? What do you secure? Never invest in a product you don't understand. Simple. Simple. Be sure you have enough information before making an investment. Ask questions until you are satisfied. Understand the risk involved in your investment. Investment always entails some degree of risk. Know who is investing your money. Does the salesperson work for the bank or a third-person broker dealer? Okay. Uh, Mutual funds are not FDIC insurance. Mm, no capital appreciation. Sensitive to interest rates fluctuations and monetary policy. But again, this is a faster way to get liquid. Money market funds are regulated under the Investment Company Act of 1940. History of money market fund. But in any case, money market involves the purchase and sales of large volume of very short term product, of very short short-term debt product, such as overnight reserve or commercial paper. Mm. A money market fund may invest in the following type of debt financial instrument: banker acceptance, certificate of deposit, bank issue savings certificate with short-term maturity. Mm, commercial paper, unsecured, short-term corporate debt. Okay, repurchase agreement, short-term government security, U.S. Treasury, short-term government debt issue, short-term government security, short-term debt guaranteed by a commercial bank, by savings, bank issue saving certificate with short-term maturity, and commercial papers, secure, commercial papers, that's right, commercial paper. Mhm. Interesting. Interesting. So next company must next company must account interest, income and expense. So interest income is money that a company deposit or keep. It's money that a company, yeah, money that a company made from keeping their cash in interest saving account, money market funds, that this involve the purchase and sale of the purchase and sale of uh, large amount of, yeah, the purchase and sale of large volume of very short term debt, such as overnight reserve or commercial paper. So in there you have is banker acceptance, so short term debt guaranteed by commercial banks, certified certificate of deposit, so bank issue savings certificates. Okay, so you're buying is debt from a commercial bank, banker acceptance. You buy debt from a commercial bank. You you buy this certificate of deposit or bank issue savings certificate with short-term maturity. You buy corporate debt, commercial paper, unsecured short-term corporate debt, or repurchase agreement, which is short-term debt issue. So, or you buy the debt of a commercial bank, or a corporate, or a corporation, or the government, or you get a savings certificate. You get a bank issue savings certificate with short-term maturity. Okay. Fuck. But after all, you're buying debt, or so after all, you're buying debt from a bank, from a corporation, from the government, or a bank issue savings certificate with short-term maturity. Jesus. But after all, this is purely debt. After all, it's purely debt. After all, it's purely debt, man. Okay. Interesting. Interesting. Yeah. After all, it's purely debt. Holy crap. Holy, holy crap. Mm, okay, okay, okay. So money market. So to recap, so money market involving the purchase and sale of large volume of very short-term debt, such as commercial paper, such as commercial paper or overnight reserve. An overnight reserve is this money market invest in instrument in debt-based financial instrument. That's what happened. So money market fund invest in debt-based financial instrument like uh, short-term, exactly, but all of them are short-term. Short-term debt from a bank, from a corporation, which are very unsecure short-term corporate debt, or for the government. But also, bank issues saving certificates, or also bank issues saving certificate with short-term maturity. Interesting. With short-term maturity. That's interesting. That's interesting. That's interesting. Mm, mm, revenue and earnings. And earnings. They lay off a lot of people. But I think that this is because the huge amount, the huge printed money, this doesn't take in consideration is inflation. But in any case, okay, so that's very very interesting to know. That's very very interesting to know. So okay, so after depreciation and operating expense has been deducted from gross profit, you arrive at the or the income from operations, right? Of operating profit interest, before income and interest, before interest and income tax expense. So next, company must account exactly. So company must account the interest and income expense. The interest, the interest income and expense. So interest income is the amount of money, uh, or is the money company made from keeping their cash in saving or in interest bearing saving accounts, money market funds, which is the purchase, which involve is the purchase is a financial instrument which involve is the purchase of large volume of very short-term debt, such as uh, overnight reserve or commercial paper. So these money market funds, which are debt-based financial instruments, they can purchase short-term debt from banks, corporation, which is very risky, uh, governments or bank issue savings certificate like this, or bank issue savings certificate with short-term maturity. Mhm. And the like. And on the other hand, interest expense, and again, these are just financial instruments. Okay. And on the other hand, interest expense is the money that a company pay for borrow money. Okay. So some income statements show interest income and interest expense separately or combine them together, right? So for example, when I look at the Coca-Cola here, it shows them is the interest income, okay, the amount of the money the company make from keeping their cash on saving bearing or interest bearing saving account, money market, and the like. The money market is the purchase and sell of large volume of very short-term debt, reserve, such as overnight reserve or commercial paper. So money market is a type invest in the following type of this financial instrument. Exactly. So money market invests, or money market fund invests in the following debt-based financial instruments. Short-term short-term debt from a commercial bank, from unsecured short-term corporate debt, short-term government debt issues, or bank issued bank issued saving certificate with short-term maturity. Interesting. Okay. Very, very interesting. And the like. Sorry. And on the other hand, interest expense is the money that a company pay in interest for money they borrow. And some income statements may have this separately. Okay, so for example, here they have this separately or combined. So the interest incomes and expense are then add or subtract from the operating profits. So the interest incomes and expense are then added or subtract from operating profit. Are then added or subtract from uh, from operating 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 income. hmm From operation profit or income from operation profit or income from operation. hmm This interest, the net interest income. Okay, the net interest income. And finally, income tax is deducted, and you arrive at the bottom line. Net profit or net losses. So net profit is also called net incomes or net earnings. This tells you how much the company actually earned or lost during the accounting period. Did the company make a profit or did it lose money? Most income statements include that. And then I look at the cash flow statement. Okay, so that'll be all for this video. Take care. Bye bye.